Hello friends, in this video we learn about the monetary policies given by Reserve Bank of India. Reserve Bank of India make the evaluations of this monetary policy on every 2 months and the governor change as per their expectation of the economic growth, and through this way the monetary policy is to be issued. Let's see the basic introduction. Monetary policy is the policy which regulates the demand and supply of money into the economy. If demand and supply of money not to be remaining in equal manner, then it will be create the imbalance in economy. So that's why reason inflation and deflations occur. So that's why reason Reserve Bank of India take the proper protective and preventional steps and stabilize the economy. So this policy is also known as a stabilisation policy. Monetary policy have the mainly intentions on today for control over the credit and also maintain the demand and supply, means the volume of money supplied and demands of money. By this way monetary policies work. Let's see the introduction of meaning of monetary policy. In short, we can consider that the policy or the financial policy which regulate the demand and supply of money, then it is called as a monetary policy. As per the formal definition, we learn about it. Monetary policy constitute the conscious step undertaken by the monetary authority which bring about the changes in the stock of money, source or the generations of money and cost of money. Otherwise, the second definition, the policy which entrusts the various tools of regulating the supply of money in the hands of the apex bank with the purpose of achieving general economic objective is called as monetary policy. In the simple terms I told you at the first, the policy undertaken by the apex bank for regulating the supply of money in order to maintain the economic stability, keeping into consideration the process of economic development and interest of public is called as monetary policy. In short, I told you the financial institutions which maintain the proper coordination between demand of money and supply of money and regulate it, this type of policy is called as a monetary policy. Monetary policies are affected by the two different types of tools or the reforms. First is qualitative reforms. What is the meaning of qualitative reforms or the tools? When Reserve Bank of India creates the impact on the specific or the certain sector and for that purpose a particular policy is applied, it's called as an qualitative tools or the qualitative reforms. In qualitative tools there are 4 different type of measurements. Number first, security requirement. As per the Reserve Bank of India's guideline, every commercial banks are liable to give the loan to the public by getting the proper security as a reserve. Without it, they are not liable to give any kind of the loan. Just like if any common man want to get the loan, then they mortgage some property, some land, some house or jewelry or the car, etc. type of things. Without it, no one banks are liable to give you the loan except personal loan, but they have their own economic standards. So every bank have to get the proper security and then after loan will be released. If bank will not follow that type of things, then it will be create the biggest bad debts or the NPA for the banking system, and it will be creates a bad loan for the banks. So the economical stability of the economy cannot be maintained in very well manner. According to the people and the level of people, security requirement is different as per the example of industrialist and example of agriculture sector. Number second point is margin requirement. No one bank can give the higher or excess loan rather than decided margin by RBI. As per example, if a person want to take the loan in against of their house, then bank only and only give the 50 or 60% amount of the houses as a loan, because if a person will not pay this loan, then they automatically forfeit their properties and recover or repay their debts. So that's why reason a margin is required. Number third is selling on credit. Reserve Bank of India also prescribed the selling for the credits for the different purpose. Selling for credit shows the credit limit. Means according to their limit, every bank gives the loan. This limit can be calculated or evaluated by the economic condition of the person. And last topic is discriminatory interest rate. Discriminatory rate of interest is suggested by RBI because every type of people and profession have not a profit margin or not an equivalent profit ratio. For that purpose, to motivate the poor sector, Reserve Bank of India apply the discriminatory interest rate policy. That's why reason Reserve Bank provide the loan to the farmer on a 4% rate of interest as per example, and they provide the mortgage loan or a car loan worth 8, 9 or 10%. So this is the way discriminatory rate of interest have been seen. This is the qualitative reforms or the tool. According to this way, Reserve Bank of India can maintain the control over certain sectors. Let we make for the further discussion by quantitative reforms or quantitative tools. Quantitative measurements are the aim at impacting the entire economy in a general or the common way, and hence they are known as a general measurement or a quantitative reforms. In short, quantitative reforms means the reforms which are affected to the entire economy. Whatever steps is taken by RBI are affecting to the whole economy is known as quantitative reforms. In quantitative reforms, we learn about 7 different reforms. Let's see. Number first, it's called as an bank rate. Let's see the proper way and with the example. Demand and supply of money can be controlled by RBI with the different tools. Let's see what is the meaning of bank rate. When Reserve Bank of India lend the money to the commercial bank for the long term period, and whatever rate of interest is to be charged by RBI from the commercial banks, then it is called as a bank rate. See, as per the basic example, if market is going in inflation, at that time Reserve Bank of India try to control the supply of money. For that purpose, they increases bank rate. If RBI increase the bank rate, then bank get the funds on a high rate of interest. So they deliver the loan to the people as again the high rate of interest. So automatically people don't get the loan and supply of money can be controlled. Instead of getting the loan, people deposited their money into the bank to get the high rate of interest. This policy is called as an dear money policy. Another second step is to be also taken by RBI. When market is passing from recession, in this situation, supply of money in the market is very low. So Reserve Bank of India try to increase in the supply of money from the market. For that way, RBI reduces the bank rate. So commercial bank get the lower rate of interest oriented loan, and the same loan will be passed to the public with the lower rate of interest. So people encouraged to get the loan and supply of money will increases in the market. This monetary policy is called as a cheap money policy. Through this way, Reserve Bank of India control the requirement of demand and supply of money into the market. Nowadays, Reserve Bank of India utilize repo rate and reverse repo rate instead of bank rate, because bank rate is working for a long term, but the repo rate and reverse repo rate are working for the short term. In 2016, bank rate ratio was percentage was 7%. In short, the basic explanation was given. In inflation, bank rate will raises, and in recession, bank rate will reduces. Number second, that is repo rate and reverse repo rate. Nowadays, Reserve Bank of India utilize this tool for maximum control over the demand and supply on money. When any commercial bank have the requirement of a short-term fund for 1 day, 7 day, 15 days or 6 months or maximum to 1 year, at that time, this repo rate and reverse repo rate system is to be used. Repo rate, in short, it's called as a repurchase rate. As per the basic example, when in the market inflation is going on, means supply of money is higher. At that time, Reserve Bank of India raises the repo rate, so commercial bank get the loan from RBI for a short term period on a high rate of interest, means the repo rate. If commercial bank get the higher rate of interest oriented loan, then it will be also passed to the public by high rate of interest. So people are not ready to get the loan. So automatically the supply of money controlled. But when the recession is to be going on, at that time Reserve Bank of India reduces the repo rate, so people are ready to get the loan with a lower rate of interest and supply of money rises. So this is the way where repo rate can be fluctuated. In inflation, repo rate will raises, and in recession, repo rate reduces. But for that way, every commercial banks has to mortgage some securities in against of RBI, and RBI give them a loan. But number second point is reverse repo rate. When Reserve Bank of India have the funds at that time for a short term period, Reserve Bank of India get the funds from commercial bank on the certain rate of interest. This rate of interest is called as an reverse repo rate. Normally, repo rate is a higher than reverse repo rate. You have been observing the data. April 2016, repo rate was 6.5% and reverse repo rate was 6%. And as I told you, in a short, in inflation, repo rate raises, recession, repo rate reduces. Let's see, going for third. Stabilisation under emergency situation. This is the special window offered by RBI to the commercial banks. If any commercial bank have the requirement or a shortage of cash or a liquidity, at that time, Reserve Bank of India provide the loan for a requirement time duration period, and that is called as an marginal standing facility. The rate of marginal standing facility was 7% in 2016. Through this way, in emergency, Reserve Bank of India helps to the bank. Number fourth is cash reserve ratio. We learned the cash reserve ratio in the previous video in terms of credit creation process. Actually, every commercial banks, they get primary deposits on which they have to maintain the minimum reserve fund, which is known as cash reserve ratio. Cash reserve ratio was decided 5% on the demand deposit and 2% of the time deposit, but instead of nowadays, since 1962, CRR is the variable between 3% and 15% of the total deposits of individual banks. According to the CRR, Reserve Bank of India controlled the demand and supply of finance. Let's see the basic example. When the inflation occurred, at that time, Reserve Bank of India control the supply of money from the market. For that purpose, they raises CRR ratio, and if CRR will increases, automatically the lending capacity of the bank reduces, so credit creation reduces. And in the recession trend, Reserve Bank of India reduces the CRR, so bank have to maintain less reserve fund and lending capacity of bank will increases, which will be encourage higher credit creation. Through this way, cash reserve ratio become helpful. Another point is statutory liquidity ratio. According to the basic ideology, CRR maintained on a primary deposits as a reserve. But statutory liquidity ratio shows that every bank have to maintain minimum 20% deposit of demand and time deposit both in form of cash, gold and government securities. So the liquidity of bank can be maintained, and whenever the bank have a requirement of the funds in the emergency, then bank mortgage all that gold and cash or not a cash but gold and government securities in front of RBI and get the funds, as well as MSF, marginal standing facility. So that's why reason statutory liquidity ratio is required. When in the market statutory lending ratio will raises, at that time lending capacity of bank reduces and bank become more liquid. Liquid in sense of more cash flow can be generated by bank. But whenever the SLR reduces, means statutory liquidity ratio reduces, banking lending capacity increases and lower liquidity has been seen. According to this way, statutory liquidity ratio control the position of bank's liquidity. Let's see OMO, open market operations. Open market operation refers to sale of or the purchase of the government securities in terms of the bonds in the open market. So open market operation is the tool where RBI utilize this tool whenever the recession and inflation arises. When inflation occur in the market, people have more money, and Reserve Bank of India want to control this money from the market. For that purpose, Reserve Bank of India sells the securities. So security has been sold and money has been received. So automatically supply of money controlled from the market and RBI maintain the liquidity. But when the recession arises, at that time Reserve Bank of India push the liquidity into the market. At that time Reserve Bank of India purchase the security from the government and dispatching the lots of rupees into the market in terms of cash. So automatically the economical balance will be improved and liquidity will be released. Through this way, through this OMO, Reserve Bank of India control the liquidity. And the last tool is Sterilisation Policy. Sterilisation policies is the policy in which Reserve Bank of India maintain the foreign exchange reserve. In this reserve, a simple ideology and the simple example is that when value of rupees is deteriorated in a context of dollar, so at that time dollar becomes stronger. Reserve Bank of India sell the dollars and control the market from depreciations of rupees. But when in the market rupee becomes stronger and dollar become weaker, at that time Reserve Bank of India purchase the dollar on a lower rate and maintain their foreign currency reserve. Through this way, sterilization policies is to be worked. By this way, Reserve Bank of India making the fluctuation in the foreign reserve fund in terms of dollar, and through this way they can maintain the forex reserve balance. Through this way, Reserve Bank of India take the quantitative steps which are affecting to the whole market. In this video, we learn about the monetary policies, whatever steps is to be taken by the governor and which will be implemented in the real economy. Have a nice day. Have a great day.